YouTube, what's up? Welcome back to the show, the Coinist Podcast. If you're new here, hit the like and subscribe button. It really does help me in the YouTube algorithms. On today's show, I have on Kevin Kelly. He's the co-founder of Delphi Digital, one of the top research firms in the space. They put out a ton of good analysis about Bitcoin, but also what's happening in the macro global market scene, right? What does the QE mean? What does the money printing, stimulus? How do all these things affect Bitcoin? We make that very easy to understand in this episode, so stick around, stay tuned, find out, and enjoy the show with Kevin Kelly. Also, after you hit that like and subscribe, check out the sponsors right down below this video. They make this show possible. Enjoy the show, guys, and I'll see you next time. I think I hit the right button. Kevin, we should be live. What's going on, brother?
How you doing, man? Been a long time.
Doing well. It's been a full... it's April 3rd. You know what's crazy? It might be a year exactly.
Yeah, wow.
Yeah, I know it's April 2019. I don't know the date, but been a full year. What's going on?
Same old, man. I love saying that because in crypto every day is different, and every week's different. And I think actually Bitcoin's probably trading decently close to where it was 12 months ago when we last chatted. So a lot certainly changed, but some have stayed the same.
Yeah, it's the thing that stays the same is how fast things change, I guess you could say.
Yeah. That's a good way to put it, for sure.
What you're in New York. How's that? You're kind of the epicenter now of the United States for the coronavirus outbreak. Not you personally, but location wise, how's New York right now?
No, it's a bit eerie, to be honest. My apartment's in Williamsburg, so right across the water in Brooklyn. So it's kind of eerie looking out and seeing the New York skyline and knowing, I mean, things are obviously still all lit up, but knowing that the city that never sleeps is actually, under a mandated kind of, sleep policy right now. So it's a bit eerie, but, I think we're starting to get, at least our team's starting to get in the groove of, working remotely, luckily with, our business being focused on research consulting. It's something that we can do, pretty much anywhere. So we're not, fortunately, tied to, foot traffic or something like that. But I know a lot of people are struggling. We've talked to a lot of teams who are struggling. So it's certainly trying times for a lot of people here.
Yeah, we talked about that briefly when we just hopped on a moment ago. Some projects or coins specifically are struggling. What are you seeing there? We don't have to name specific names, obviously, but are token projects having to lay people off? Kind of, what's the feel there? Because I just spoke with Dan Held yesterday. He works at Kraken. It's like exchanges are kind of actually doing really well right now, right? They get paid based on volatility and fees. What about some coins?
Yeah, so just kind of general sentiment. It's kind of a cop-out answer, but it depends business to business or token to token, obviously. Yeah. But I mean, you've certainly seen, a bit of fallout in terms of, I mean, if your native crypto token or asset drops 50 to 60% in a matter of, 4 or 5 weeks, and your treasury management strategy, you have a lot of that sitting on your own balance sheet, right? Because again, you have issuance schedules and all of that. You certainly can see, and we have seen, a wrench thrown in some development plans, some projects and teams that thought they had, let's say, 12 to 18 months of runway, that got, shortened pretty quickly. And so it's still too early to say, how I think this will play out. I mean, certain project teams will be able to access, whether it's, VC funding as a lot of these projects are already funded, potentially tapping credit lines if they're large enough or have those already established. But we are seeing, as I mentioned, a lot of pain to go around and a lot of even just uncertainty and uneasiness and people kind of pushing back development potentially just because they don't know, what the next, let's say, 3 to 6 months really holds.
I wonder, I'm just thinking this now as I'm hearing you kind of talk about some of these tokens and how they would have to get capital. Let's say if a token does run out of money or their runway is shortened, if there's like a second round of Corona catalyst-driven ICOs, right? Or at least, maybe not an ICO, but they put together some format or some contract or some structure where a VC comes in or another project comes in and buys their tokens and gives them some funding. I'm curious if we could actually see something like that.
No, I think one thing about crypto, that you and I have talked about is you never, you got to bet on innovation, right? You got to bet on human ingenuity. And I'm sure if push came to shove, people will get pretty creative in terms of some of the financing and structures that they come up with. So not to say that that's a time we want to get to or that we're excited, but I certainly wouldn't count crypto out yet.
Yeah. Yeah. So Kevin, a ton has changed. Really, the reason I wanted to have you on here, not only to catch up, but last time we talked, it was a year ago, and I think our conversation was mostly focused on the Bitcoin UTXO analysis you guys put out. That was the beginning of 2019. It was April actually, and Bitcoin was still around 4K. We had just been trading in between 3,200 and 4,200 for about 2 or 3 months. A lot of people were saying, back to 3K or even lower, whatever it might be. You guys pretty confidently, or I guess you could say with a high conviction rate, thought that UTXO analysis showed the bottom was likely in. People know what happened after. If you're listening and you're unfamiliar, Bitcoin rallied from about 4K almost to 13K. So now that we're at the same price, the environment is a little bit different. What just happened recently before we kind of go into what I want to cover, which is like a 101 of what central banks are doing and what it actually means for Bitcoin. In the past 2 weeks, Bitcoin sold off just like every other asset, right? Equity sell off, gold sells off, oil sells off. Bitcoin is not excluded from that group. Why does everything sell off together? What is the liquidity crunch? What does that even mean?
Yeah, no, absolutely. So what you've seen kind of in traditional markets and how this has spilled over to, Bitcoin and I guess crypto more broadly is you saw this kind of real, what we deemed as the inflection point, right? And I've been tweeting about it a little bit, kind of leading up to mid-February. And then February 19th, I actually put out a short Twitter thread on Twitter, just kind of airing out some of my thoughts because you saw a lot of differing or conflicting things happening in traditional markets. One of which was you had a stock market that continued to roar higher. February 19th was the all-time high and right where the stock market peaked. But at the same time that stocks were rising, you saw bonds basically rallying as well, right, and rising as well. And when prices rise, you see bond yields fall. And so the two were basically telling very, very conflicting stories about what, the future for not only economic growth is going to be, but what financial markets could expect. And so just put something out and said, listen, we're seeing conflicting signals here. And right then was kind of the turning point. I think you finally had an inflection point where the market really, or at least equity investors really woke up to the severity of what this coronavirus and COVID-19, outbreak really meant and how, again, serious it was going to be, right? And up until that point, it's not to say that it was dismissed or entirely discredited, but it certainly wasn't, I don't think, really in the forefront of equity investors' minds until you started to see that roll over. And so what that basically created was this cascading effect where different trading strategies or investment strategies, things like risk parity, where you're basically allocating capital based on the volatility of different asset classes. And so when volatility is really low, oftentimes you'll introduce potentially more leverage for your fixed income side of your portfolio. But you'll basically kind of weight or allocate based on what you think, the volatility of these different asset classes could be and try and create the optimal portfolio. And so what happens is if volatility kind of blows out, let's say in one part of the market like stocks, but it doesn't show up in bonds, which in a true liquidity crisis, you basically see volatility blow out everywhere. And that's exactly what we saw.
Yep.
And times when that happens, you get this kind of chain reaction where you're selling pretty much, you're rebalancing and selling constantly because equity prices continue to fall, right? And so you're cutting down on your risk exposure, and that just creates more selling. And you have this environment that really kind of becomes and feeds on itself and becomes its own beast in a sense. And so what we saw was a lot of kind of forced selling, forced liquidations. And as that happened, and as volatility blew out across asset classes, investors, traders, everyone kind of started to pull back and stopped producing or giving liquidity to the market because they simply didn't know what was going to happen, right? You had certain trading desks at banks saying they didn't even know how to price, treasuries, which obviously is, considered one of the safest and most liquid markets on the planet. And so when you have times like that, you get this kind of panic sell where it doesn't necessarily matter what the asset is. If you can get any type of decent liquidity on it, you're probably going to sell it, right, from an investor perspective. And so that's where I think we were talking a little bit, before we hit record about, the BitMEX situation, everything that went on there, and certainly that exacerbated things on the Bitcoin side. But you also saw, I think, the fact that you have more kind of institutions or I should say global macro funds, some of the smart money getting into Bitcoin and crypto during periods like that. you also run the risk of having to liquidate their Bitcoin positions because, again, they are constructing portfolios in a kind of multi-asset sense, right?
Sure.
And so that's kind of a high-level overview of what at least we saw in financial markets and kind of how that's spilled into crypto. And now it's kind of the dust has settled a little bit. Conditions, and we'll get into the kind of monetary and fiscal side of things and how central banks have really pumped liquidity into this market to try and calm things down, and it's started to work a bit, and you are starting to see some of the pressures be alleviated, but that period really was kind of a week and a half, 2 weeks, was extremely volatile and scary for a lot of people because no one really knew what the next domino to drop was going to be.
Yeah. What about things that are traditionally thought of as a hedge? When things get this crazy, you can think about gold as a systemic hedge, kind of the bellwether, safe haven asset. Even gold dropping significantly. You have oil down. President Trump was talking about $9 a barrel. I know it's rallied since, but what about other assets? I mean, this wasn't just stocks, right? Gold down significantly. We saw basically everything sell off.
Yeah, no, you had the everything rally from 2019 pretty much flipped on its head in the latter half of Q1. And to your point, everything was down. I mean, a quick side note when it comes to oil prices, I mean, you had, because there's different grades of oil, you actually had a certain grade of oil that was trading at negative dollars. It was a negative price on oil because there was just, again, there was so much turmoil and storage and all of these things. So gold, though, is a really interesting parallel because, and you saw this back in 2008, 2009, March 2008 through October, I mean, gold sold off a little bit more than 30%, even as stocks cratered, right? And so when you think about a safe haven or a macro hedge or store of value, kind of name your whatever adjective you want to use there to describe these types of assets, it's important to understand the environment in which you're in. And when you have a liquidity crunch and you have this kind of panic selling mentality, again, anything with liquidity, and gold is a very liquid market. Anything with decent liquidity is probably going to be on the chopping block, right? Or it's going to get put under the guillotine. And so that's what you saw with gold. I think at one point it dropped 15% between, I think it was like March 8th through, the following week, about 7 or 8 days. It had about a 15% drawdown from 1,700, right? So to your point, the argument, and this kind of leads into the argument for Bitcoin as a macro hedge, and a lot of people throwing shade on that. Yes, the drop in Bitcoin and the drawdown was really significant. It was larger than gold, but that's what you would expect with something that's a lot more volatile and it's kind of your high beta call option on digital gold long term, right? You can't really have your cake and eat it too and say, I want to have asymmetric return potential and all this, upside volatility without, recognizing that you're going to have more significant drawdowns and larger downside volatility to complement that.
Yeah, anyone looking for that upside and being long any risky asset right now is feeling the pain. So what kind of the bulk of this and the real reason I wanted to have you on, there's so much information being thrown around on Twitter right now, memes being thrown around, memes kind of ruling the narrative as they do. One of them that has taken hold, I think it actually made it to The Economist. I imagine we're going to see it on CNBC pretty soon, is money printer Gober. Mm-hmm. And it's about, how much money is about to be printed. The word QE gets thrown around, stimulus gets thrown around. And I think a lot of people probably wonder, what the hell does this all mean, right? Does it guarantee that Bitcoin will actually do well if the government just keeps printing money? I don't think people can tie necessarily a direct relationship and say, oh, the government's printing money, oh, Bitcoin still hasn't moved and gold's down too. Like, I don't understand this relationship. So when people do say, kind of a meme breakdown, money printer Gober, what the hell are they talking about for the average listener, for someone who looks at that and says, why isn't Bitcoin going up? What's going on there?
Yeah, no, absolutely. So one of the important kind of caveats is the transmission mechanism by which these governments or government agencies actually pump money into the system is extremely important, right? And I mentioned that because you saw a massive quantitative easing, and I'll explain really quickly, what that is at a very basic level, but basically a lot of money getting put into the system and central bank balance sheets blowing up. And you saw that for, a good part of the last cycle, and you didn't see inflation really take off, right? And that's been kind of what a lot of economists have kind of been scratching their heads about. There's a number of reasons for that, but one of them comes down to kind of the actual transmission mechanism by which, money enters the market or enters financial markets and eventually, gets to consumers' hands. And so quantitative easing, and what we've seen, I think it's about $6 or $7 trillion already in just more quantitative easing or asset purchases announced by global central banks. Basically, what they're doing is they're trying to fight a lot of deflationary pressure and this potentially catastrophic economic downturn that we're seeing just based on social distancing and mandated quarantines and all of this. And so what it basically is you have banks are the kind of primary. A lot of people talk about the central bank is creating money, right? But most of the money creation actually happens at kind of the commercial bank level, right? And that's through like the lending process, right? So you come in, you have deposits, you lend out money, and the fractional reserve banking system allows you to basically lend out a lot more money than you have on hand at any given time, right? So that creates or increases the money supply. And so what's happening now is, at a time when you have a liquidity crunch and you have a ton of uncertainty, right, and you have something like a global pandemic that's facing the economy and markets, at a time when banks are probably, if you're a lender, right, and risk is going up or uncertainty is going up, you would probably tighten your lending standards, right, because you don't know how many of these businesses are actually going to be able to withstand, let's say, 2 months, 3 months, 6 months, maybe 12 months, without revenues coming in the door, trying to keep employees on payroll, things of that nature. So at a time when banks are trying to basically tighten their lending standards, the central bank's coming in and saying, okay, we need to basically bolster up the reserves of these banks to encourage more lending and encourage credit to continue to flow throughout the system.
Yep.
And so what they'll do is basically it's kind of like an asset swap where these banks will take their treasury holdings and the central bank, the Fed in this case, will buy up those holdings, exchange for bank reserves, right? And the reason why it's a key difference is because banks the fractional reserve system doesn't work with treasury holdings or holdings of different securities or assets, right? If you have reserves, those are what banks can actually go out and lend. And so basically what, central banks are trying to do by pumping money into the financial system to say is lubricating the wheels of markets, right? And saying, okay, even though standards are probably getting tight here, we need to keep credit, again, flowing to households, flowing to businesses. And so they do that in kind of large scale. Where I think the disconnect sometimes occurs is just because the amount of money that's being put in the system is increasing, that's not a necessary guarantee that things like gold or Bitcoin or inflationary hedges will increase, because it's not a guarantee that you're going to actually see inflation. And that's, again, something we can probably dig deeper into. But the way in which money enters the system is extremely important. And so what you saw, following 2008, 2009, a lot of quantitative easing happened. Central bank balance sheets blew up. By blow up, I meant increased, dramatically.
Yep.
And that money kind of stayed or got trapped within the financial system, right? You had massive asset price inflation, right? Had one of the best bull markets for stocks, for example, the longest bull market if you're looking at the actual duration. You had asset prices pretty much across the board increase, but your average consumer person, right, didn't really see a whole lot of real wage increases. Inflation was very tepid. And so I think what's different this time around is you're starting to get the other prong of policy, which is the fiscal side of things. And I think that with these ideas of like helicopter money, where you're literally taking money and putting it into the hands of the consumer, right? So it doesn't have to go through an intermediary, it goes through an intermediary, but doesn't necessarily have to go through all the usual intermediaries within the financial system. The helicopter money aspect, actually putting money into the pockets of the American consumer, and this is happening globally, but we'll use the U.S. as an example, that's something that could actually end up sparking inflation, because again, that money's actually making its way to, an American consumer's pocket, whereas with quantitative easing and with pumping money into the kind of financial system, it's almost like you can lead a horse to water, but you don't necessarily have to make it drink, if that makes sense.
Yeah. Yeah, so the printing takes off, obviously, in the wake of the last financial crisis, right? 2008, and QE round whatever starts, and that exists for a long time, and we just don't see inflation kick in. So stocks do very well. I think, immediately when the word QE gets thrown around, especially when they're using verbiage like we'll do whatever it takes or unlimited QE, immediately, and maybe this is just me seeing this on Twitter, I think I'm seeing it on Bloomberg and other places as well, people are saying, look, unlimited QE is happening. Inflation is going to be through the roof. This is ridiculous, right? Hyperinflation is going to be here next year. All these different things. Maybe not that. Maybe I'm overstating that a little bit. But people are getting very eager or pretty optimistic, I guess you could say, about how inflation is going to lead to Bitcoin doing well. You're saying that fiscal stimulus might be the thing combined with QE that actually gets us there. What is helicopter money? You're talking about the stimulus checks, right? That people would get?
Yeah, exactly. So you're talking about, I mean, for the U.S., for example, looking at, let's say every American that qualifies would get something around $1,200, right? And I'll caveat too in that I don't think even though it's a $2 trillion stimulus package that we saw passed in Congress over the last week, I still don't think that's going to be enough, because you're already seeing a lot of holdups or delays within, small business lending, for example, which is literally the lifeblood of the backbone of the American economy. So you have to either get that sorted, ASAP, or you need to actually pump more money into the system. But yeah, the fiscal stimulus side is really interesting because, again, it can have more of kind of a direct effect on consumers. The other, caveat here is that we even use things like stimulus packages, right? And using the word stimulus, but it's really not stimulus in the typical sense right now. Right now, it's really just trying to support American businesses, support employees, basically create this monetary and fiscal bridge to get us across this massive crevice that we've come across in terms of the potential economic downturn that we're facing because of all this mandated social distancing as a result of COVID-19. So it's not necessarily a stimulus package in the traditional sense, but again, putting money directly into the pockets of people and having that be a more direct or effective way, I think certainly could lead to inflation. It depends on how deep and how long, and really the duration of how long this goes on, and how big the fallout is in terms of economic output and economic activity on things like GDP and things of that nature. If it's shorter lived, I think we get across that bridge and we find ourselves on the other side with a lot more money in the system than potentially was necessary. But right now, policymakers want to err on the side of putting too much money in the system rather than not doing enough and then being blamed for not coming to the rescue of the average, small business in America, when they had, obviously a negative connotation around the bailouts that happened in 2008 for some of the biggest banks.
Yeah. And I'm thinking about helicopter money and how fast governments have to move. Obviously, right now it's a game of either we pump too much money into the system, we recover too quick, and now we run into those problems later on, or we just have to come to the rescue. But thinking about helicopter money, hasn't the Bank of Japan tried this? Weren't they the most recent kind of central bank to have something like this?
Yeah, so you saw it in I think Hong Kong actually did it probably 6 or 7 weeks ago. It was kind of one of the first, because that obviously went around Twitter a good amount.
Yeah.
And the helicopter money is finally here. Japan's a really interesting case because they are kind of the poster child for extreme quantitative easing, extreme monetary policy. They own a vast majority of the Japanese government bond market. They own, I think, somewhere north of 70% of the domestic ETF market at this point. So, I mean, their balance sheet is absolutely insane. It actually surpassed their annual GDP. I think it was the latter half of 2019. So they now have a balance sheet that's larger than the annual GDP. But one of the big differences between them and somebody like the U.S. is a lot of that debt is actually held internally, right, or domestically, whereas a lot of the debt of the U.S. treasuries are held by a number of foreign central banks. Treasuries are one of the largest kind of reserve assets for the world, which again, we can get into kind of why the US dollar is the global reserve currency and why we talk about things like unlimited QE. But we also have to put into perspective is the amounts or the size of what we call a global dollar shortage. Basically, the world right now is short on US dollars. And so the Fed has kind of identified that as, you could say, the Achilles heel of the global economy right now. And it's probably going to take advantage of that in a big way because they can continue to I guess, pump money into the system, pump dollars into the system because the demand for dollars right now is so high, right? So they're basically just giving the world what it needs, and they continue to use that, almost to their advantage because, again, the world is so short, has this large dollar shortage. But again, the big difference between the U.S. and Japan is more so that our debt is more externally financed, I guess you'd say, and so that can have some long-term repercussions if we have really, really irresponsible, monetary policy going forward.
But right now, in the short term, since there is this kind of dollar crunch, everyone wants the dollar, right? It's risk off. It does give us just a little bit more room, or at least it seems like.
Yep.
I guess what you're saying is, if we take all that room and maybe take it too far, the implications down the road are even worse. Let's go down that road then. Why does the whole world want the dollar instead of, why isn't there kind of a massive demand for euros? Like, why doesn't that give the ECB all this runway to kind of go, I know they are kind of taking down some restrictions on what the central bank can buy, but I don't think every other government can say, we have unlimited QE, we have this much runway because everyone wants the dollar. Why does everyone want the dollar as opposed to other monies?
Yeah, so one important trend that you've seen really over the last, we'll call it decade or so, is there's been a pretty sizable explosion in dollar-denominated debt, right? So foreign, whether it's foreign companies or even sovereigns issuing dollar-denominated debts, right? And one of the reasons why that's been in such high demand is because a lot of investors, right? If you're a U.S. investor and you want to get exposure, let's say, to potential growth trends that are happening in emerging markets, right? You might not want to take that local currency risk because, again, if country runs into trouble, they try and do something similar to what the Fed would do as a global reserve or leverage a global reserve currency and just print a bunch of money. That country would probably face massive kind of currency debasement, and you as an investor in that local bond that's based in local currencies would be subject to huge currency risk, right? So long story short, the demand for dollar-denominated debt has increased, and there's been an explosion in dollar-denominated debt. And so what that basically keeps is a bid on the dollar, because again, if you're trying to service those debts, if you're trying to repay those debts, repay the principal on those debts, you constantly have a growing kind of dollar liability base, right? And so that increases demand for dollars at a time when the monetary base of the U.S., for example, hasn't increased as fast. And so that's really where you're starting to see this big gap show up, and it's really caused some significant kind of dislocations within financial markets because there's such a big bid for dollars relative to the supply currently, and it's also at a time, to your point, where the dollar has always been considered, or I shouldn't say always, has in recent memory been considered a safe haven, right, or kind of the world's currency, reserve currency. And so at a time when you have very tumultuous markets, volatilities blowing out, that's a time in which people are going to rush into either dollar assets or the dollar trying to hold dollars themselves. And so those kind of combination of things, where you have just such an explosion in demand versus the actual supply of whatever it is that's in demand, you're seeing a bit of a dollar squeeze here. And it's why a lot of people actually still think that unless the Fed prints somewhere north of or adds another 5 trillion to their balance sheet, something in that range, you're going to continue to see dollar strength, because again, that demand is just so high right now.
Do they have to now consider, not only kind of QE and stimulus to maybe be a bridge to get us through kind of this corona impact and bring the economy back on track and stabilize the markets, but they also have to think about now what you just stated. If the bid remains so high, if the demand stays so high for the dollar, to make it stop rising in value, we have to print even more. Is that something they're thinking about? Is that like a real, it's like it's two forces battling each other, both trying to do separate things here, but they both kind of point towards more QE. Is that something they really consider?
Yeah, so it is something they consider. It's something policymakers know. They know it's a risk. I think it's maybe a bit naive to think they don't understand like how that mechanism works. Where I think we get into a bit of trouble is talk about things like unlimited QE, right? That applies up into a certain point, and that certain inflection point, we'll call it, would basically be when you actually have that supply of dollars, right? If we do this too quickly or we do too much of it, the supply of dollars will outpace the demand for them, right? And once you hit that inflection point, obviously that could lead to currency weakness. Where I think longer term we get into trouble is if you look at the national debt of the U.S., which on paper public debt's I think about 23 trillion now. With this new stimulus package, and let's say we'll probably get at least another one, even if it's a smaller package, you're looking at 25 plus trillion on national debt. If that continues to rise and you can see budget deficits or fiscal deficits rise, at a certain point too, as the global reserve currency, you have to wonder at what point will foreign investors, right, who are buying into treasuries and buying into this kind of risk-free narrative, and the U.S. is the safest place to be. It's the safest market in the world. It's the strongest economy. At what point do foreign investors start to question and lose confidence that eventually those debts will be paid and the dollar will be able to maintain its value, right? And the reason why that's important is because, as you know, markets are as much kind of a confidence game as they are, understand the underlying fundamentals. And when you see confidence get removed from the market or swept out of the market, similar like what we just saw with this massive carnage in Q1, things can escalate really quickly. And so if you start to see, countries and foreign investors and foreign central banks start to lose confidence in the fact that the U.S. Can continue to sustainably either service these debts or eventually one day obviously have that amount of debt come due. If the U.S. can no longer at a certain point roll that over, that's, I think, where you start to get the real true downfall or dethroning of the dollar. The tough argument right now is what currency would replace it, right? And there really isn't an obvious choice right now. The dollar is kind of the best house in a bad neighborhood, as a lot of people like to say. And that's where a lot of people have come in and made the argument for Bitcoin and saying like they should be, the world's global reserve currency. And while I do sit in the camp that I think eventually if it really does pan out how we think, it could certainly sit as a kind of global digital reserve asset. I don't think you ever get to a world where you have kind of one currency that dominates them all, right? And fiat's entirely doomed. I think you're going to have fiat for a long time. It's just a matter of the relative value between them, right? And kind of having the risk return trade off of, how much stronger can the dollar get? What is your time horizon? Long term, there's a lot of things that are potentially going to be structurally weakening the dollar. But in the near term, everything leads to further dollar strength because, again, the bid underneath it right now, the demand for it is just so high.
Yeah. I'm sure there's some Bitcoiners right now that even though they agree with you and they're watching the dollar strengthen, they're shaking their head and saying this will be the global reserve currency, but they got to wait. I'm like you. If fiat's going to stick around, central banks are going to stick around. There's a lot of whether or not it's been proven that eventually they'll act irrationally and the currency will fail. They still play a pretty pivotal role in kind of everything happening right now. Let's stick with Bitcoin. Dive into your most recent Bitcoin report. Delphi Digital, for everyone listening that hasn't checked them out, puts, in my opinion, some of the best Bitcoin kind of reports out there, combining what's happening in the market, the technicals, also with the fundamental backdrop. And when we talked last, Kevin, like we said at the beginning of the show a year ago, your UTXO analysis was maybe the most important piece of research I saw written in 2019. You guys had that high conviction thought that Bitcoin had bottomed based on when coins were moving. What does the UTXO analysis show right now? I think that was the first slide in your most recent report. What's that telling us?
Yeah, so quick recap on what we do with that UTXO analysis, and I appreciate the kind words as always. Basically what we look at is, and what's really, honestly just fascinating about this space and one of the reasons why I love it so much is you're able to try and pioneer these different metrics, right? And different unique indicators that you otherwise wouldn't get other asset classes. I come from the equity world and you don't have things like UTXOs for stock, but neither here nor there. Basically, we look at the unspent transaction outputs. What it allows us to do is basically track, as you mentioned the last time, Bitcoin, certain portions of Bitcoin moved, right? And so what we can do is basically create different age bands and say, okay, this percentage or this amount of Bitcoin hasn't moved in 6 months, hasn't moved in 1 year, hasn't moved in 3+ years, 5+ years, so on and so forth. And so one of the instrumental things about that December 2018 report that we came out with, that we basically said we think there's going to be a bottom, it's either bottom tier, we're going to have a bottom, before the end of Q1, is because you saw a good amount of selling pressure. Obviously, you had Bitcoin kind of fall off a cliff there in Q4, and then you had final capitulation between these long-term holders, and we saw a real kind of sell-off in terms of some of the longer-term age bands, right, where you had some of these longer-term holders kind of throwing in a towel and saying, okay, this might not be for me. If they're selling out of Bitcoin for whatever reason. And so again, just like other markets, you try and look for kind of turning points or contrarian indicators, right? And final capitulation is always going to be one of those. And so that was what gave us the confidence, along with some other longer-term technical indicators that said we thought a bottom would be in. Fast forward to today in our most recent report, we looked at, again, breaking down those UTXO bands. You saw a lot of the recent selling actually was from more on the shorter-term holders. front. So it wasn't necessarily all these longer term holders. You've actually seen accumulation continue, which gives us, again, a bit of confidence as well that there's a lot of people out there that feel that Bitcoin still has, a long-term viable potential. And what we paired that with was looking at exchange flows as well, right? And so what we saw was not only was a lot of short-term holders selling a lot of that trading activity, but we also saw some pretty sizable stablecoin inflows into exchanges this month back in March. And you saw a sizable amount of Bitcoin actually being taken off exchanges as well, right? So again, there's different motivations and different reasons for people to do this, but by and large, what we think is that, you have obviously dollar inflows, and then you have people buying Bitcoin and taking it off exchange and then holding it hopefully for the long term. So those types of things are what we look for to try and give us confidence that we're maybe potentially going to start forming a bottom. I think right now it's a really difficult time for a lot of the reasons we've talked about, because, for example, if you saw another kind of wave of massive volatility within financial markets and another wave of selling, yes, I think a lot of the weak hands have been shaken out in the crypto market, but that doesn't stop Bitcoin from, kind of following equities and going in this kind of risk off mode, following equities down, the rabbit hole, because again, people just are trying to shore up as much cash and flock to cash at a time when uncertainty gets so high. So it's a very tough time to say, we think, the bottom has been in for Bitcoin, and I would be surprised if we saw it dip again below 4K. But that being said, it's a very, unique time right now, because you have interest certainly actually growing within Bitcoin because of all the things that are happening on the monetary and fiscal front. But at the same time, in the short term, this is certainly potentially a trader's market, right? We haven't really seen a huge trend yet. We haven't seen a breakout. And so right now we're kind of, I guess you'd say, neutral, but longer term, the long-term conviction within Bitcoin has only been, I would say, heightened because of what's happening recently.
The medium to long-term outlook, it's the adage, watch what they do with their money instead of what they say, is really sticking out to me, because as you look across Twitter and you see it on, I haven't seen too many Bitcoiners on CNBC recently. I imagine that'll pop back up around the halving. But as you look across blogs or Medium posts or these threads, it seems like there was a serious uptick in how many people say, you know what, I lost conviction in Bitcoin long term based on how much it sold off. Compare that with your UTXO report and the Bitcoin report I just read that Delphi put out, and it shows that that's just not the case. That's not what people are doing with their money. The people that have bought and sold, bought their Bitcoin a year or two ago still aren't moving it. And all the coins that are moving and changing hands are still very short term, like you said, a trader's market. So that was kind of an interesting highlight there that I thought you laid out. Yeah, go ahead.
There, because I've seen the same thing where some people have thrown in, and again, a lot of people still have such a vested interest in Bitcoin being, again, this kind of ultimate non-sovereign macro hedge, because the non-sovereign, censorship-resistant, digitally native nature of it is unlike anything we've ever seen, right? And again, you toss in a hard cap supply, and literally Bitcoin is it seems like it should be the ultimate asset. This is what's happening now is kind of Bitcoin's Super Bowl, right? Like, this is what it literally trains for, is built for. And when you see it, draw down 50% at a time when a lot of people were on the sidelines saying, cheering it on, it's easy. I can see how people would lose faith pretty quickly in that, because they had so much built into that narrative, right, or so much invested in that narrative. I think it's too early to call that narrative dead, just because, again, of all the reasons we talked about with different safe havens that have sold off. Gold has sold off in prior liquidity crises, sold off a bit. In this one, I think it's much more important what Bitcoin does in kind of the aftermath of all of this. And I will say that I think the timeline for Bitcoin to really prove itself has certainly been pulled forward, just because we've had such a massive pull forward of monetary and fiscal policy, and the amount of money that you're going to see kind of injected in the system in one form or another. I think that timeline over the next, let's call it 18 to maybe 36 months, I think is a really, really important critical moment for Bitcoin, because the backdrop for it is now kind of the stage is set, right, for it to perform well. It's a matter of if you can get enough conviction, enough people to buy into the narrative and see the real true value of it, and have price, take off and outperform other assets. I think, again, you pulled forward kind of the timeline, which has to prove itself. But the side note I was going to mention is I've seen an influx of people from, college roommates and friends to one of my uncles who reached out, who are now actually looking at Bitcoin because they're reading the headlines and seeing on the news all these different things that are happening on the monetary and fiscal policy front, as I mentioned. And so you've seen some people throw in the towel who have been in crypto for a while, but at the same time, you're seeing a ton of kind of new interest from people outside because everyone's looking for, that ultimate asset potentially to not necessarily be the saving grace, but something that they can lay their head down at night and have confidence in, that it won't be devalued or it won't be subject to monetary policy decisions that are, out of the everyday, average American's hands, for example.
With the timeline move forward and the potential for inflation, all these forces, kind of what Bitcoin was made for, right? It's moment to shine. Do you think it's important that, let's say gold does start doing well with this backdrop? Let's say, inflation, we actually do see that kick in. Some people are already pointing to the economy's going to have a V-shaped recovery. I think Tom Lee from Fundstrat was saying that the other day. Let's say we see all those things, right? There's a hypothetical. And gold starts doing well. Do you think it's really important for Bitcoin's narrative to at least be keeping pace or doing well with gold? In the past, and as long as I've been in Bitcoin, and still currently, I think a lot of people say, oh, it should be uncorrelated. It doesn't matter if it trades with gold. It doesn't matter if it trades with stocks. This thing should be uncorrelated. Let it do its thing. But let's say gold does start kicking in based on this backdrop, based on the money being put into the system. Bitcoin, in my opinion, does kind of need to do well based on those things. Do you think that's an important relationship to track?
No, I agree with you. And I think one thing that's important to note about the historical relationship between Bitcoin and other asset classes is, yes, it's been uncorrelated, especially over longer time periods. But one of the biggest reasons for that is because, again, the incremental buyer of something like Bitcoin versus, gold, which gold market's extremely institutionalized at this point, the incremental buyer is very, very different, right? So it's, again, one of those situations where you kind of want to have your cake and eat it too. As more people buy into the Bitcoin narrative, right? Hypothetically, if we get more people to buy into the Bitcoin narrative, more, again, smart money, global macro funds, people who really put, sizable amounts of capital to work buying into the Bitcoin narrative, as it gets integrated into more institutional type portfolios and sophisticated investors hold this in a multi-asset portfolio sense, just by nature, it's the correlation between Bitcoin and other assets will increase. It depends on which assets that it increases relative to and which ones it decreases relative to, right? So if it takes off as this kind of high beta option on digital gold, and when, let's say gold over the next 12 months, again, very hypothetical, if gold ran up 25% and Bitcoin ran up 50%, and it was just, again, this higher kind of beta version on broad-based fiat currency valuation, the gold narrative, but on steroids, the correlation between Bitcoin and safe havens like gold will increase because, again, you're gonna have more institutions that are viewing it from that portfolio perspective. Yeah. So I think it's an important clarification that historically there hasn't been much of a correlation at all, or pretty much no correlation between that and other assets, because the incremental buyer has always been very much retail. And even over the last, let's call it 12 months, where you've seen some more sophisticated investors come into this space, again, it's still, the incremental buyer is still very, very different. And so as those two things converge, just by nature, you're going to see Bitcoin and its correlation, the way in which it reacts to certain, whether it's macro events or what have you, it's going to increase its correlation to something.
Yeah, it's maybe some people haven't liked it, but there was a week or two that went by in March with the Trump pressers coming out every single day, talks about stimulus and announcements about when the bill is going to pass. And it was like, for the first time, it felt like trading Bitcoin was trading FX again. You're sitting here, you're watching central bank decisions, you're watching to see what the president says, you're seeing it react in real time. It was a maturing step. And I know that some people look at that and say, that's nonsense. We shouldn't be watching this anyway. Bitcoin's going to do what it will, and maybe it will for a short period of time. But I think, like you said, those relationships are going to be more and more intertwined. Kevin, what I want to wrap with is probably the most powerful slide you guys have in that report, and something that I think a lot of people should consider, kind of tying together this whole show. With the memes being thrown around of unlimited QE, with the memes being thrown around of money printer Gober, I think it's a hell of a meme. I hope it makes it to every news network. But with those narratives being thrown around, I think a lot of people look at Bitcoin and say, this is a sure bet. And look, I am bullish as anyone on Bitcoin, right? I do this. A massive amount of my net worth is in Bitcoin.
I was buying on the way down.
Yeah.
I'm right there. My bags are packed.
Yeah, all those things. So I don't at all want to downplay my expectations for Bitcoin long term, but I do want to highlight what you guys highlighted in the last slide, which is, I'm going to flash a chart on the screen for everyone watching. If you're listening, check this out on YouTube. You talk about why QE isn't the golden ticket, why it's not just a risk-free trade. Just because money is printing does not mean that Bitcoin is going up, back to all-time high this year. Call it next year, whatever it is. Why can you kind of make that claim? Why do you think that's important for investors to think about?
Yeah, I think there's a couple interesting points here, and if I'm thinking of the correct chart, it's also showing gold versus the S&P 500, right? So kind of the relative performance of gold versus the U.S. equity market. And the reason why we wanted to include that was because, again, as you've seen this carnage in markets, first off, Bitcoin will also have to compete. Investing is all about opportunity cost, right? So if you're gonna put your money into Bitcoin, for example, that capital wouldn't be sitting in, let's say, U.S. equities, right? So investment managers and funds are now going to have to, portfolio managers are going to have to evaluate, what they think the long term, and long term can be anywhere from, let's call it 12 months to, the next 10 years, what they think the outcome or the outlook for different asset classes is going to be, and where Bitcoin fits into that. And so, since you've seen a pretty sizable drawdown, the expected forward returns for something like U.S. equities buying in right now is certainly higher than it was, back in mid-February, for example. But the point of it not being necessarily a golden ticket, and this kind of goes back to the transmission mechanism in which money kind of enters the system. If you saw something where it was another kind of 2008 where you had, bank reserves. If you had the central bank balance sheets blow up, and you had, again, them just buying treasuries and mortgage-backed securities and basically swapping those for the reserves for banks, and that money didn't end up getting into consumers' pocket and really didn't end up moving around the system, you don't necessarily see something like inflation, right? I think as we come out of this and as we get past kind of the coronavirus outbreak, and you start to see demand come back a bit, and you see the economy reopen in a lot of ways, what I think is going to be interesting, and this kind of gets into the longer term paradigm shift that we're seeing, but I think you have a pretty good argument for inflation picking up, even outside of just pure, monetary policy and central bank policy, because you're going to have a lot of redundant systems built, here domestically within the U.S. I think what, this entire pandemic has showed is just how fragile a lot of global supply chains are. They've sacrificed things like efficiency, right? Or they've increased efficiency, but they've become more dependent on, China or some of these other countries for some of either the products in which or materials that go into certain products that are created. So long story short, there's a lot of reasons why I think inflation could actually pick up, not necessarily just because of central bank policy, and this is where the fiscal aspect comes in. Depending on how money enters the system and how that money is then, used, right? I think that is how you kind of base your potential argument for inflation going forward. And I don't want to get too into the weeds of a lot of different reasons why we think inflation could certainly pick up. But it is an important kind of caveat because, again, you saw gold really outperform the S&P, for example, in the first, let's call it, I think it was about 2 years, 18 months to 2 years following the bottom in March of 2009 for stocks. But then, as you saw the dollar kind of re-strengthen in mid 2014-ish, really ramped up. I mean, that was suppressing gold prices. And you had real outperformance in financial markets and those types of assets, right? So long story short, it's not the kind of end all be all. And it really depends on how some of these other asset classes actually perform as well. And so that's what's a tough juncture that we sit at is, yes, we think the case for broad-based fiat currency debasement, certainly that risk has increased just given everything that's going on. But it's not to say that the entire system necessarily is guaranteed to collapse, or the fiat currency system is guaranteed to collapse in and of itself, just because you're seeing, the money printer Gober and things like that.
Yeah, it's I love the meme. The stage is certainly set for Bitcoin. Yeah, but it doesn't make this a free lunch. It doesn't make it a risk-free bet. If you have a risk-free bet, feel free to comment below this video or fire something on iTunes or whatever it is, because I'd love to have it. But right now we just don't see it. Kevin, thanks a ton for coming on, laying out the entire macro backdrop. I know there's a lot of people that look at the memes, at the words being thrown around. They say this has to be positive for Bitcoin, and I think long term and medium term, it's setting up the picture that it can be. But I think it's also important to say it's not risk free. It doesn't mean we have to moon. And what are the actual kind of mechanics or the reasons that would cause that price increase, that would increase the chances of Bitcoin success? So thanks for coming to break it down. And yeah, man, do you have any update on, has New York given, I haven't watched Cuomo's briefings lately. Is there any update about when New York is going to be back online? Is it like the rest of the country? We're all waiting until April 31st, aren't we, or April 30th?
Yeah, I was going to say the 30th is kind of the right now the benchmark for us. But just talking to a lot of different people, I mean, certain companies have already extended that to the end of May. They're talking about people going to kind of A and B teams. So I honestly don't think you see New York really back to 75-80% of its previous capacity, probably until, unfortunately, somewhere around June at the earliest. Just because, again, quick side note, I think the worst thing you can do, the only thing that's worse than this is reopen the economy too quickly, and then you have to shut it right back down because, we did it too early, right? It was way too premature. So I think that's a tough battle. I think the human psyche and a lot of concerns are still going to be in the air even throughout this summer. So it's definitely trying times, and it's definitely a bit eerie, as I mentioned at the beginning. But we're all sitting here. Our team's safe. Our team's healthy so far. So we're counting our blessings for sure.
Yeah, definitely got to be thankful for that. I saw Singapore, I think, just went through that. They got off of lockdown, or whatever you want to call lockdown. Every country is going through a different definition of lockdown, but I believe they just kind of went back through more tightening or kind of having to bring some of those restrictions back in. So yeah, I like you and like everyone listening, we want to get back outside. I was telling Dan, I really take for granted just going to a bar, sinking my teeth into a burger. There's a lot of times I would complain about that and like, oh man, why am I paying these prices or whatever it is? But I think everyone's gonna enjoy those luxuries even more when we get back.
Well, the post-corona party, I think, in New York is going to be absolutely one for the ages.
It will.
Everything's open back up, so that's I guess what we're looking forward to at this point, because a lot of things have either been delayed or canceled. Yeah. So I mean, it's just our turn to put our heads down and just do research, because there's pretty much nothing else to do.
Well, we got a lot to look forward to, both of the Bitcoin backdrop and also that Corona party. Maybe I'll make it back out to New York for that. It'll be fun to check out. All right, Kevin, thanks a ton for coming on. Enjoy your weekend, man. And I don't even know what the weekend is anymore. Every single day is the same. But yeah, but enjoy your weekend, and we'll talk soon.
All right, man. Thank you. Appreciate it.
Yep.